everyone, you're watching HMJ Study channel. Today we'll see 11 Commerce Accounts, Chapter 1 Introduction to Bookkeeping and Accountancy. In this part 1, we'll see the bookkeeping and accountancy in detail. The evolution of accounting. During Chandragupta Maurya's time, Minister Kautilya wrote a book named as Arthashastra. The book was regarding the way of maintaining accounting records. In the earlier time of civilization, accounting was done by the agents who managed the properties of wealthy people. They prepared accounts periodically for the owner of property. In 12th century, the records of debit and credits were found. In the year 1494, Luca di Bago, an Italian merchant, introduced double-entry bookkeeping system. In 18th and 19th century, the large-scale operations were carried on and joint stock company emerged as an important form of organization which involved separation of ownership from management. In 20th of century, the need for analysis of financial information for managerial decision making caused emergence of management accounting as a separate branch of accounting. And in 21st of century, though the accounting was an individual centric in the initial stages of evolution, it has gradually developed into social responsibility accounting in this century. And this is due to vast growth in the business activities. The next is bookkeeping. Its introduction. Bookkeeping means recording of business transactions in the books of accounts in a systematic way. Bookkeeping is related with the activities of recording business transactions, and business transactions business activities involves exchanging of money or for money's worth. Information about business is required only by the proprietor, manager, and also the government, investors, customers, researchers, etc. So there was need of bookkeeping. Bookkeeping means recording of business transactions in the books of accounts in a systematic manner. Bookkeeping is an art or science of systematic recording, classifying and summarizing the financial transactions of business for a particular period, generally 1 year. R.N. Carter have defined bookkeeping as bookkeeping is the science and art of correctly recording in the books of accounts all those business transactions that results in transfer of money or money's worth. Features of bookkeeping. Systematic recording. Bookkeeping is the method of recording day-to-day business transactions in a systematic manner. Only financial transactions are recorded here. All the records are prepared for a specific period which are useful for future reference. Records of transactions are based on rules and regulations. Bookkeeping is an art of recording business transactions scientifically. The objectives of bookkeeping. The main objective of bookkeeping is to keep a complete and accurate record of financial transactions in a systematic, orderly, and logical manner. Bookkeeping serves as a permanent record of the monetary transactions of an enterprise business, and it can be produced as an evidence whenever or wherever required. The fourth is to know the profits and losses of the business. The bookkeeping is used to know the assets and liabilities of the enterprises and to know what the businessman owes to others and what the others owes to him. to compare the financial results with other business enterprises. Businessman comes to know the current year's progress over previous year and compare its financial results with other business enterprises in a similar line. The next is the importance of bookkeeping. Bookkeeping is not possible for anyone. Actually, it is not possible for anyone to remember all the transactions, but bookkeeping maintains records of all the transactions permanently and systematically in the books of accounts. Financial information. Bookkeeping is useful to get information related to profits, loss, assets, liabilities, investments, stocks, debtors, creditors, etc. at any given time. Decision making. Bookkeeping provides information, financial information to the businessman for decision making. The information regarding profits earned, loss suffered, debtors, creditors, assets, liabilities, goodwill, etc. are very useful to undertake any important decision. Controlling. Bookkeeping enables the executives of a business to control all the activities of the business. It also helps to take a right decision at the right time. Evidences. Businessman needs financial evidences to be produced in the court of law in case of any disputes. Therefore, the bookkeeping is useful as an evidence whenever or wherever required. Tax liability. Bookkeeping is useful to find out the tax liabilities, for example, income tax, property tax, GST, etc. The utilities of bookkeeping. Bookkeeping is utilized by many, or it is useful for many. First is owner. The businessman or the owner can find out the profits or losses, assets, liabilities of enterprises at any time. It is utilized by management too. Management of an enterprises can plan, take decisions and control over all the business activities. So it is useful for management too. Investors can properly study all the records, or they can take the proper decisions whether to invest or not. It is useful to customers too. Customers can easily understand the financial position of the business. The customer can be assured about the supply of goods. It is utilized by the government. Government can easily find out different types of taxes due from various sources. And lastly, the lenders. The money lenders can find with the financial position or the financial standing of the enterprises for the decision to lend money or not. The next we'll study about accountancy. Bookkeeping is a part of accounting. It is the primary stage of accounting and it is the process of recording transactions in the books of account. Here, accountancy is the practice of recording, classifying and reporting of business transactions for a business. Here it follows accounting principles. These principles are adopted by the accountants universally. The definition by Kohler. Accountancy refers to entire body of theory and processes of accounting. Here, in the difference between the bookkeeping and accountancy, it will be more clear. First of all, meaning of it. Bookkeeping is concerned with recording and classifying the business transactions, whereas accountancy is related with recording, classifying, summarizing, analyzing and interpreting the financial data. The stages. Bookkeeping is primary stage. It is base of accounting. And apart from primary stage, the accountancy includes secondary stage of analysis and interpretation too. What are the objectives of it? The objective of bookkeeping is to keep the records of all the financial transactions in a proper and systematic manner, whereas the objective of accounting is to prepare the financial statement and further communicate the information to the relevant authorities to take proper decisions on proper time. What are the responsibilities? Who are responsible for maintaining the accounts? In the bookkeeping, junior staff is responsible, and for accountancy, senior staff is responsible. What are the outcomes? Bookkeeping basically results in journal and ledger, and accountancy results in profit and loss account and the balance sheet, where the position of the business comes to know. The periods. Bookkeeping gives day-to-day details and accountancy gives details of entire year. Analysis. The process of bookkeeping does not require any analysis, but accountant uses bookkeeping information to analyze and interpret the data and then compiles it into the reports. The next is decision making. Management cannot take decisions based on the data provided by bookkeeping. But here in the accountancy, depending on the data provided by the accountants, the management can take critical decisions of the business. What are the skills required? Analytical skill is not required for bookkeeping, whereas in accountancy, analytical skill is required. Okay, so that's it about bookkeeping and accountancy. Thank you.